The total asset turnover. Here we take the total assets and divide them into the total sales. And we get 5.1 for 2012 and 5.3 for 2011. So it's very consistent between the 2 years. What this tells us is management using the assets to generate sales. So the shareholders have given these assets to management to use to generate sales, which in turn generates a profit. And in this case, they're able to turn those assets over 5 times, which is very good. And there's very little change between the 2 years. Of course, to truly evaluate this company, we would need to compare it to industry averages to see how they stack up against their competitors. Now here we're only looking at the fixed assets. And this firm has a very small dollar amount of fixed assets to the number of sales. They have, here you would see $79 billion in sales and only $780,000 in fixed assets. So they don't have a lot of bricks and mortar out there that they are have built or have invested in. So this is very unusual to find a fixed asset turnover that's this large. But there was a considerable drop between the 2 years when we went from 11 to 12. So this meant that they did make some investment in some fixed assets during that period of time. Average collection period refers to how long it takes us to collect our accounts receivable on the average. And to do this, we are looking at the sales divided by 365, and then we divide that into our accounts receivable, and we get 18 days. So again, in 2011, our sales, $80 million divided by 365 into our accounts receivable, we get 17 days. This is an extremely short collection period. This means that on the average, from the time that the customer buys the merchandise, that the company, Amerisource, has the cash back in their hands within approximately between 17 and 18 days. It's not unusual at all to find collection periods of 30 days or even up to 40 days. So this is very unique, evidently, to this company. They are very, very heavily invested in their current assets and very lightly invested in their fixed assets. And they're turning these current assets very rapidly. And you'll notice that the payable period on the other side that we saw earlier for their vendors is only 46 days. And now when we look at inventory, we see the same thing happening. Here we take the cost of goods sold divided by 365 days to get the average amount of cost of goods sold in a particular, on the average day. So it was 210 and it was 212, 335. So then we take the average amount of cost of goods sold per day and divide it into our inventory. And we see that it's 27 days in 12 and about 26 days in 2011. It would not be unusual at all to find inventory turnovers of 65, 70, even in some cases up to 90 days. So again, I want to emphasize the fact that this firm has a very, very short operating cycle. They are getting the sales out there, collecting the money, turning the money over, buying inventory, turning it over very rapidly. So this is all happening within 1 month, which is very unusual. Now we want to look at the leverage ratios. In other words, when we're talking about leverage, we're looking at capital related to debt, and we're looking at assets related to debt. So the first one we have is called the total debt to total assets. So how many of our asset dollars are being financed by debt? And then we have the equity multiplier, which is total assets divided by total equity. So how many of our assets are being financed by equity from our shareholders and retained earnings? And then we have a ratio of interest coverage. In other words, how profitable are we in covering our interest as it comes due? Our lenders will be very interested in that, and this is quite often is a figure that appears in loan covenants where banks and bonding companies require that you maintain a certain interest coverage, and if you fall below that interest coverage, you're considered to be in default. So here we look at the total debt to total assets, and is 0.84 and 0.81. This is a very high leverage, so a very high percentage of our assets are being financed by debt. But a lot of this debt is tied up in our current liabilities. Now, a high leverage indicates to the investor or the lender that there's a more risk involved in when you're investing in this particular firm. It comes down to this point. How much room does management have to secure more debt? In other words, you only want so much debt. And here, again, I want to emphasize the fact that 90% of the firm's debt are tied up in their accounts payable, and they have only a small portion of long-term debt. And if you'll remember, we are turning our accounts payable in 46 days. So I would look back at that figure and place a lot more credence on that than looking at the total debt to total assets. Again, I want to emphasize that there's not a lot of bricks and mortar involved in this type of operation. They're a warehousing company, and they turn their assets very fast. Now, the equity multiplier is basically a reciprocal of what we saw in the previous slide. In other words, this tells us what percentage of the assets are financed by capital, by stockholders' equity. Here is a very small ratio to the total. So they have a very light capitalization as far as equity is concerned, and a lot of capitalization relating to the liability side. And again, I say this represents a high leverage, but I would not be concerned in this company because of the way in which they're managing their current ratios and their payment period. And you need to compare these between each other. You can't look at one of these and say, well, this is the answer, this is the most important ratio at all, because just as we've done here, where this firm is peculiar in its corporate structure and the way it's handling its finances, you need to look at the current ratio, and you need to look at the accounts payable payment period and the inventory turnover and the asset turnover. You can't just look at the leverage and the equity multiplier to determine whether this firm is a risky investment or not, because the management is doing an excellent job in managing their assets and their liabilities. Interest coverage. Here we take the operating income and we add back any taxes or and interest. So here we take the $718,986,000, add back the income taxes, and add back the interest expense. And then we divide this by the interest expense. And what this says is the amount of money the firm is earning before taxes and interest is very sufficient to pay interest as it comes due. They have $13 available for every dollar of interest. And in 2011, they had $15 of income versus every dollar of interest. They would have no trouble making their interest payments on their long-term debt. And as we realize, they do not have a lot of long-term debt, so you would expect this to be a high ratio.